Normally we bombard you with charts, and many of them sitting in the extreme in whatever metric you're looking at. The one below should be front and center right now, but the metrics you are looking at are only half the story. Yes, the last 8 recessions in the US were all preceded by an inversion of 10-year and 3-month US Treasury yields. On Wednesday, that inversion occurred for the first time since the COVID crash in 2020. But unlike then, this time we have the kicker of the 10-year UST having a yield of 4% with 8% inflation. There is absolutely no Fed to the rescue fairy tale ending going on here. So let's revisit how we got to this situation with some non-static charts for a change. Sometimes we forget the journey when we sit at the destination. First, let's remind ourselves of how gold, real money, has held value compared to fiat currencies around the world. Part of the problem with that debasement of currencies, and you can see the kicker above from the GFC, is the prolific amount of new currency created by central banks. Quantitative easing sees them print new currency and buying bonds with it. The graphic below shows you just how prolific that was. Such debasement of currency ordinarily leads to inflation, more money chasing the same amount of things. As we all now know, the mechanism of that printing just saw financial assets and property inflate, enriching the rich, but until last year, it didn't flow through to ordinary goods and Main Street. The graphic below shows you how house prices have responded since the 80s after the penny drop that we were no longer tied to the discipline of gold and you could borrow newly created currency to buy one. It's a bit of a Bledisloe Cup battle between Australia and New Zealand, with the same result we've gotten used to in the rugby too. Aussie housing ended up 290% in that period. Another hard asset protecting wealth amid such currency debasement is gold. It's up over 400% in the same period. Clearly one of the two looks overvalued right now and the other one quite arguably undervalued. Can you guess which? Finally, the next graphic puts the current shocking 4% 10-year US Treasury yield mentioned above into perspective. The graphic ends in April 2022's 2.8%, but you know the rest. The $300 trillion question today is whether that 40-year decline in yields may be coming to an end, and are we witnessing a breakout of that established channel that has fueled this distorted, debt-fueled financial largesse? Never has the world held so much debt, and never could rates get back to previous levels with such a burden. Something must and will break. All of the above may be nothing new to our regular watchers, but sometimes we need to revisit the journey to connect the dots. Thanks for watching. Please like, share and subscribe, and balance your wealth at ainsleyBullion.com.au.